What's up, YouTube? It's Joe Catchpolia sitting on the couch, making some money, investing in fractional real estate online, as usual. So far this week, I've only bought stuff on Lofty, nothing else. But I am, still plugging away, buying real estate online. I wanted to take a little bit of a break from talking about any of the platforms for a couple minutes to start. And just talk about, I don't like to talk about the macro economy that much. If you have paid any attention to my investment philosophy, I'm very much not in the predicting business, right? I don't think that I never want to have to be right about a guess about the future. It's a big part of why I'm a value investor and I'm looking at buying things at a discount to today's value. Like, what is this worth today? Am I paying less than that? Um, that takes a lot of pressure off having to figure out what's going to go on in the future because I think that in general, humans are just terrible at predicting the future. Every once in a while, you'll find someone who has, outperformed everybody else, but you never really know if they've just gotten lucky or if they really know something that we don't. Warren Buffett has a great analogy where if you took I think if you took a thousand gorillas at the zoo, or maybe 100, I don't know what it was, and you had each of them flip a coin every single day, um, every day, and if it was heads, they failed, and if it was tails, they get to keep going to the next day. And so every day, predictably, you'd lose about 50% of the gorillas, right? They'd flip a coin, so you go to 1,000, then to 500, then to 250, then to 125. And so as days would go on, you'd have these gorillas that would have outlasted many others. And, it would take a very long time to get down to just the one gorilla who had flipped heads every single day. And you'd think, oh, what is his secret, right? What's he been doing that everybody else hasn't? And if it's truly just a fair coin, the secret is that was the one outlier, right? That's the one that got lucky. And if you have a whole bunch of people making predictions, I might have butchered that story a little bit, but I think you'll get the gist, right? But so if you have a whole bunch of people making predictions and making bets online and investing in stocks, I think of it as very similar to making bets. And I don't know that I've talked about this on this channel. I do play poker quite a bit. I got into poker when I was, studying finance in college, and realized that the outcomes in poker are much more predictable than the outcomes in investing, right? For example, if there's one card to come, and you know how many cards that you know how many cards in the deck are left that could possibly help you. The math is very simple to figure out what are my chances of getting there? What are my chances of winning and losing? Where I don't think that there's any possible way to predict, with certainty, what the outcome of a certain investment is going to be, especially if we're talking about sometime in the future, right? And so that's why I'm a big fan of diversifying my investments, right? Trying to buy across a lot of different properties, and which is one of the great things that investing in fractional real estate has let me do, and also why I'm just trying to buy at a discount to today's value, right? Because I'm never having to guess. I'm having to make some assumptions and figure out what today's value is, but I'm never having to guess what's going to happen in the future. So anyway, that's why I don't talk about the macro economy very much. But I think we've just had such interesting few days that it's worth at least just taking a quick peek at and thinking about how this could impact our real estate investing. So first thing, looking at an S&P 500 chart, this is year to date. So if you're somebody who's, oh, okay, I'm investing in broad index funds, I'm going to buy the S&P 500 index. This is something you hear a lot of people talk about. Congratulations, you're down almost 14% for the year, right? Now, obviously, if you zoom out, that's year to date. If you zoom out to the year, you're only down a little less than 3%. If you zoom out 5 years, hey, I made a ton of money, right? And if you go over the max that just this chart goes, which is not very far back, you've done very well, right? So over long enough periods of time, I think it's probably a pretty safe bet. Although I'm not telling you that's what you should do because I'm never trying to give you investment advice, and especially not in stocks because it's just not my forte whatsoever. But it is, you know, it's a tough year if you were trying to hit a certain retirement number, right? There's a lot of people, okay, once I've got whatever 5 million bucks in my retirement account, or let's say 10 because it'll make the math easier for me, right? I have 10 million bucks in my retirement account. I'm going to retire. Yesterday you thought you were a dollar away. Today you would be one, or not yesterday, but the beginning of the year you thought you were uh, just a dollar away. At this point in time, you'd be $1.3 million away, right? I mean, it'd be a huge amount of money to be missing, and that's, I think, optimistic for most people. A lot of people are trying to, figure they hit a couple million bucks and they'll retire comfortably today. Um, some people have even, more modest goals than that. But whatever the number is, to be able to just lose 13% in such a short period of time. And actually, if you look at it, like it's, most of that loss is just in a few days, right? I mean, we've had a little downtrend, but I mean, these last few days have just been horrible. If you're, if you're all in on Bitcoin, I think it's even worse. It's a little bit worse for the year to date, but it's even worse if you think about like, okay, it topped off over 100,000, and we're more than 20% down from the peak this year. Maybe we are on the S&P too. I don't know. I don't think so though. That's close. Um, so obviously if you're a full-on Bitcoin bro, you might be saying, did I say Bitco the first time too? I don't know. Bitcoin. Um, you might say, well, one Bitcoin's always worth one Bitcoin, so who cares what it's worth in dollars? But I don't think anybody actually believes that because we spend dollars, right? We don't spend Bitcoins hardly anywhere at the moment, right? Um, so I think a lot of people that have lost 20% of value in the last couple of months are probably rethinking their strategies, right? And that's sort of what I wanted to come to today is if you're one of those people, right? If a couple of really rough days or a couple of really rough months is making you think that you should change your strategy, then you probably don't actually have an investing strategy, right? Because if you're investing in really volatile things like crypto, like the stock market, um, and this is not unexpected volatility, right? Like we don't know when it's going to happen, but we know it's going to happen. There's been plenty of times in the past where we've had bigger crashes in both, and it is so uh to be surprised when it happens and to change what you're doing, I think is a big mistake. Although lots of people do it, every time, and this is start to get into the real estate part of this. Every time we see big market crashes, I always get a lot of new clients. There's a lot of people that have been like, yeah, I've been investing in stocks my whole life, and I just lost a whole bunch of money in the stock market, and so now I want to take what's left and invest in real estate because I'm looking for something more stable. And while I have been all in with real estate for basically 20 years now, um, and I think that everybody should own investment properties, and I think I think it's a great vehicle for building wealth. I don't necessarily think at the end of a traumatic crash is the moment that you should be making that decision, right? I mean, the whole point of uh, wanting to be an educated investor is you shouldn't be making financial decisions emotionally, right? It should come from math and logic and reasoning. But for whatever reason, we as humans seem to just make a lot of our decisions primarily emotionally. And so there's a bunch of people today that are thinking, there's definitely people that sold out because that's what makes crashes continue, right? It's more and more people selling. Um, and so some of those people are going to move that money into real estate, thinking, okay, that's something that's a little bit more stable. Uh, and I think that that's true. I think we have had a few big crashes in history in real estate, but if you look at these cycles, there are far fewer actual, legitimate crashes in real estate. You have market cycles just like you do in other industries, but the severity of those cycles um, is much is very much dampened, and it's dampened because it's something that's slow to transact. There's appraisals involved. People use comparable sales. People just don't sell real estate at a loss nearly as often as they're willing to sell stocks at a loss. Part of it is because it's very hard to panic sell real estate, right? Like uh, you don't see those prices on a daily basis, and even if you did, you couldn't just pull the trigger and sell it today. I mean, that's in most markets. Now, obviously, if we're on Lofty or if we're on Arc 7 right now has a secondary market too, there could be people panic selling tokens. I haven't really noticed that, although I have picked up a couple good deals. I don't necessarily think that it would be interesting to see some aggregate data on here and to see like how, if we had widespread drops in prices. I don't believe that we have, but I don't know. I don't. There's not a lofty price index, and I'm gonna have to ask the Limas, the guy who made Lofty Assist, if that's something he could put together, because that seems like that'd be interesting to see, right? Like what's the aggregate price? What's that look like? How's that moving? Um, I don't know. But anyway, so one of the things I think that, but if you look at these charts, right, this is much different from your regular real estate cycle, right? We see way more volatility in token prices. But this just really brings me back to in a market like this, I'm very happy to be buying real estate backed, tokens on Lofty compared to buying stocks because if I'm holding a stock that went down 20% this year, I don't have the option to say, okay, you know what, I want to liquidate the company and sell it for the asset value today. But if I'm holding a token in this property and the token price has gone down, but I believe that the value of the real estate hasn't changed, we can go ahead and push for a sale and get and as long as it's actually the case, right, that the value of the property didn't go down, we have this secondary tool to get access the true value of what we've invested in, where, for the stock market or for Bitcoin or any other crypto, all we can do is hope the market, comes to their senses, realizes that no, those properties or those companies aren't actually worse or aren't worth 13% less or 20% less than they were just a couple months ago. Now, at the same time, maybe they are, right? Because the stock market is supposed to be a prediction market, right? It's supposed to tell us what do we think, how do we think these stocks are going to do, how do we think these companies are going to do moving forward in time. And so that's why when you have news like what's going on with tariffs and possible trade wars and um, any sort of macroeconomic news, it has the potential to move people's expected future values for all sorts of different companies. Um, and so that's why you see moves based on that. But it's also, I think that it becomes much more pronounced with companies because it's extremely difficult to value companies. And this is something that I've talked a lot about why I like buying pieces of real estate versus pieces of companies is because it's much easier for me to figure out what this piece of real estate is worth. And then in today's world, one of the things that's nice is it's also if the value of this piece of real estate is going to change, it's typically going to change much slower over time. So, like, for example, a lot of people think like, oh, real estate prices just tanked in 2008, and they did. I mean, they went down considerably, but it actually was a multi-year crash, right? It took years to get to the bottom. It moved slowly. People were able to sell for smaller losses early on, and then bigger, and then on the way up, smaller again. But so you have where although I never think market timing is, I don't think it's usually a good strategy, but it is something that in the real estate world you actually have a reasonable chance of doing it, right? You have a decent chance of seeing, okay, prices are starting to decline. If I have some reason to expect this is going to be a really big decline this time, maybe I cash out early and I lost a little bit, but not a lot. Now, because we've had so few actual crashes in residential real estate prices, um, I don't know that there'd ever be a time I'd be so confident that the prices are going to crash that I'd want to sell out. Before the 2008 crash, I think um, there's really only three other times in our history where residential real estate had a significant crash, and significant being, a more than 10% on a national basis. Now, obviously, there are some markets that have been hit much harder than that. And I'm doing this off of memory. I haven't looked at those cycles in a long time. It might be four. I think it's just three before 2008, and that was the fourth. Um, but whatever it is, we just get far fewer actual crashes, especially in residential real estate. And I stress that because commercial real estate has a little bit more pronounced cycles, and it's because they're financing. They don't have the same government-backed subsidized financing that residential real estate has. They don't have they don't have the 30-year fixed mortgages, and some of them do, but in general, there's a lot more. Um, there's a lot more commercial real estate that's on shorter term, mortgages. Are 5 year, 10 year, 7 year mortgages are all pretty normal in commercial real estate. And so they're forced to refinance at the end of those times because a lot of times they'll have a 30-year amortization, but it's only a 5 year loan. So they end up with balloon payments. And so that makes it, a lot of times, and this is what happened in 2008 on the residential side, even is that, it was a mortgage driven crash. You had a whole bunch of adjustable rate mortgages, you had a whole bunch of mortgages with teaser rates, um, and, things that, okay, people could make a payment and then all of a sudden they couldn't. And so that's much more common in commercial real estate. So you've seen more pronounced cycles there. But I mean, you just don't see it nearly as much in residential real estate. And so I don't know, there'd have to be some really compelling data if we started to see a little dip in prices for me to think, ooh, I'm going to liquidate and then try to buy back in some time down the road, right? As long as the real estate that I own, if it has debt, has the ability to cover its debt. One of the neat things about a lot of the legacy properties on Lofty is a lot of them just had no mortgages at all and still don't. And so they're able to go, handle longer periods of vacancy. There's not a whole lot, there's not a whole lot of expenses to have to cover if you don't have a mortgage. Obviously, you still have taxes, insurance, and maintenance. Um, but without that principal and interest payment, it's pretty easy. You can have vacancy for a large part of the year and still not be a forced seller, right? And in real estate specifically, being a forced seller is when you really get in trouble because anytime you're forced to try to sell something quickly that has a naturally slower sales cycle, that's when you tend to lose money. So anyway, that's I know this is just a sort of long rambling discussion, but so what I want to talk about just a little bit more is how, and I know that's always what my channel is. If you watch it, I appreciate it because I know sometimes it's probably hard to listen to that. There's a lot of different things that I think about that I want to share, and sometimes I end up getting off on these tangents. But anyway, this whole video is a tangent today. Um, when we're What I want to think about is, okay, the stock market tanking. uh, usually is an indicator there's going to be a recession, right? They think the business outlook is worse, and so it doesn't necessarily always mean that there will be, but that's that's what they're pricing in, right? They're pricing in a worse economy. So what does that mean? If I wanted to, I'm not trying to predict, but if I wanted to be prepared for a downturn in the economy, what would I do different with real estate? Well, maybe I'd want less exposure to short-term rentals, right? If I think less people are taking vacations, if I think people are going to have less money to pay for those vacations, maybe they'll want to go on as many, but they won't be willing to pay as much money. That would be, one of the types of real estate I'd be a little bit more worried about. It's just like, the hotel business has always been much more cyclical than most other parts of real estate. And so Airbnb, I think, or short-term rentals in general could be impacted by that. And so that might be something that I want to think about going forward. As I definitely want to make sure if I have any type of real estate that has variable income, like a short-term rental, uh, I want to make sure that we're very evenly covering our debt on that investment. So I'm looking. I know I did a couple of discussions on the debt service coverage ratios as far as like how much could the income go down on a certain property and we still cover the debt. It does that debt, like when we were looking at properties on Loft or on Mogul, thinking about, they have a nice healthy reserve. I do look at their debt service coverage ratio often. But when you have the higher cash on cash returns, it's usually a good sign that you're covering your debt pretty well, right? Because that's all in excess of your debt payment. It does remind me, please like and subscribe if you haven't already. I think probably if you've listened to this video this far, you're probably a subscriber and somebody who's or at least watched several of my videos, because otherwise you'd be like, what is this guy? Why am I even listening to him talk about the economy or real estate? But also, if you want to talk about any of this stuff, please jump in the Fractional Real Estate Investor Discord. There's a link in the description of this video, as well as links to all the platforms that I'm currently invested in fractional real estate on. Do your own due diligence on all of those. Just because I'm invested in them on some of those sites doesn't mean that you should. If I pick certain properties, you should, doesn't mean you should buy those, right? You want to do all your own research on those. But anyway, uh, so yeah, when I'm on Mogul, it's one of the sites where they're always using debt. So I always want to, look at that debt, figure out, okay, do they cover that debt pretty well with their income? Do they have a nice healthy reserve? And I think that they're pretty prudent. But obviously you'd want to look at that on a case by case basis. Um, what are some things that might be helped by, a bad economy? Well, I think the rent by the room properties are a good example, right? If people are making less money than they were before, maybe they downsize from an apartment to a room rental, right? Maybe or if they lose a job, but they still have some income, they could rent a room, or, they lose a job and they get another one making less money. Um, so I think that's, those are again, you see those on Mogul. There are some on Lofty as well. There's, those platform, that strategy, I think, really is already catering to affordable housing. And so if things get tougher in the economy, there should be a greater need for that. So let's say we talk about, really paying attention to your debt. You want to have, STRs, maybe you're going to be a little bit more affected. Commercial properties, if you're invested in any commercial properties, that might be an issue. Um, one of the ones that's sort of a weird one right now, the LeClaire property, the one that is, the money that's being raised to buy that commercial strip center, or it's the McDonald's and the McDonald's anchored shopping center. I think it's 4 locations, but right now it seems like that's just a fund that's sitting in cash and may or may not end up closing on that property. How is one of the reasons I haven't really backed up the truck and just bought a whole bunch of that is because I don't know how long it's just going to be sitting in cash, because until it, is fully funded, they won't vote to do the next thing. And so if we were in a period of high inflation, There's no there's no inflation hedge built into that because it is just cash at the moment. But if we're going into a recession and inflation becomes less of a worry for a period of time, which I think it could be for a lot of people, well, then that's something I'd think a lot about. I think maybe because it is, it's a scenario where you're buying $50 for $30 or whatever the price is today. Um, what else? There's the other thing too, though. If I didn't even show you the mortgage rate, chart. This has gone kind of in the this has gone down as well too, right? Like earlier in the year, we had mortgages just 7.26%. I actually think at the end of last year, let's see, that it was even a little higher. I thought maybe it's just this chart never chopped up. Oh yeah, we had a 8 day. Uh, oh, they were eight, and it was 2023. They were eight. No, okay. So my memory is failing me here. But so it's gone down, but I had changed this so that we'd have a year to date. But you can see, they've come down. Although we did have a little spike. It seemed like they were coming down because we thought, okay, inflation is less of a worry. There's a better chance that the Fed will lower rates. All of a sudden, mortgage rates spiked again, and so it turns out that the Fed rate isn't the only thing that's affecting that pricing, right? And so if we think there's a little bit more risk in these longer term lending, well, then prices go back up too, right? So um, it is one of the things that you tend to think going into a recession that the mortgage rates are going to end up getting lowered. Um, you know, Whether or not that actually happens, who knows? But then when rates do get lowered, then people start to worry about inflation again, right? And uh, that's a lot of the cyclical nature of credit in general. And so I don't know. All of this stuff is very, um, it's very interdependent. And like I said in the beginning, I think it's very hard to predict. I think that you have all these economists and talking heads on business TV shows, and they're all like the coin flipping gorillas that we talked about in the beginning of this video, right? Like, even if you think some of them have been right quite a bit, it doesn't mean they're going to be right in the future. Um, I think one of the things I like most on finance Twitter or money Twitter is people always talking about the inverse Kramer, right? Like if you buy the opposite of what Kramer, or if you do the opposite of what Kramer tells you to do with every stock, in a lot of different periods of time, it turns out you'd actually be better off. And sometimes, sometimes the inverse Kramer portfolio or whatever does extremely well, which is super interesting. Um, but there was a time where everybody listened to that guy and he managed money and people thought he was great at his job, and now it's just sort of a joke. Um, and again, I mean, what did he really know what he was doing? And then he sort of just lost touch, or was he just the coin flipping gorilla from Warren Buffett story? And so why has he been Warren Buffett has been a successful investor? Because he's very much tied to this idea of I'm not trying to make predictions, right? And he's trying to buy value today versus make a prediction about what's going to happen in the future. And so that goes back to why I'm a big fan of Lofty, even though there are a lot of properties that you could lose money on. Anytime that I can buy something that I know is worth more than I'm paying for it today, I want to buy it as often as I can, right? And so when I know the real world value of something is X, and I can buy a piece of it at X minus 20%, um, it's really hard for me to think I'm going to lose money on that in the long run. Um, which is it just brings me back to the discounted token strategy, and that's why that's what I'm doing. Doesn't mean that's what you should do. If you feel like you have a better crystal ball than I do, then by all means try to figure out where the economy's going. And if you really are good at this, let me know, because I'm always interested in hearing people's predictions and talking about it, figuring out um, but at the same time, I've been alive long enough and paying attention to markets long enough to know that whenever people think things are going a certain way, there's always surprises, and so I'd much rather try to prepare than predict. And in part of that, like when I'm saying, maybe short-term rentals aren't going to do as well, it doesn't mean I'm not going to buy short-term rentals. I still think today, they provide the best cash flow out of any other, investment that you can buy, or in general, as on for real estate properties, right? Like they're the highest cash flow properties. But it does mean when I'm buying them, I'm going to be prudent in looking at, um, how they cover their debt, and how robust their revenue is, and how much is one of the things when I'm looking at the markets, and I don't think that I've talked about this a ton, but talking more about the drivers of guests. I show you the Air DNA a lot of times where I look at the comps, but one of the things too that I like to think about is what's driving those stays. Is it mostly business travel? Is it mostly tied to some seasonal activity? It's one of the reasons that San Antonio's done very well during times when some of the other markets have dipped a little, is that there is, we're very much a driving destination, right? So in a time when flights got expensive at certain points in time. It didn't affect us too much because most of the people that are visiting here, this isn't a place a lot of people fly to vacation. Although, I mean, a lot of people do, but on a percentage basis, there's a lot more people driving here from other Texas markets, or from not too much further than that. Um, to just enjoy, to enjoy stuff, but they still need a place to stay when they're here, right? So there's all these different things to think about, and so I do on the margins might let it affect my um, investment decisions as far as markets I'm picking. The way that I want to see a deal structured, as far as how conservative they are with their debt and with their underwriting, but I'm not going to let the possibility of a looming recession change my overall strategy. And I think that's kind of what I was talking about in the beginning, where you have, there's a lot of people that their stocks just tanked, their portfolios crushed, and they're going to sell out and rethink their strategy altogether. That's what I was saying. I think that if that's what you're doing, then you don't actually have a strategy, right? Like, I think it might be a reason to take a hard look at all the little things and maybe tweak things here and there. But if you're letting this macro stuff just change your position completely, um, I think maybe the original strategy maybe wasn't a great fit for your risk tolerance, right? I was talking to some guys last night who, were had already lost a bunch of money in crypto this year and were crushed by it. And I think that it is mind blowing to me that somebody who's going to be really devastated by a 20% down move would invest in something that's as volatile as crypto, right? I mean, it's just uh, like it is, you just have a lot of cycles, and and it hasn't been around for a long time. And so we don't even know if the cycles that we've seen are going to be, we don't, there could be some bigger mega cycles that are, that these are just little fluctuations in, right? I mean, we could see, um, I mean, who knows, and it's so, if you're going to be really bothered by a 20% move down, it's definitely not the the right asset class, right? So it's kind of, and I mean, even the stock market, it shouldn't be, right? You're, because you do have just plenty of years where you have big downs. Even though people always talk about like average 8% or average 10% return, it's always a number somewhere in between there. But that's the average. But there's plenty of years where you're 20 or 30% up, and then years where you're significantly down. And then when you average those, you get to it's not as if you're just clipping coupons. That's what they used to call it when you had, when you invested in stocks. You actually used to get a coupon book, and you would send that in to get your payments, or you could bring that to I think you could bring it to the bank when you invested in bonds. Yeah. And But so like old guys will refer to, receiving your monthly payments as clipping coupons. I know that's, I guess I hung out with too many old guys, and now I'm the old guy who's saying that, and it doesn't even make any sense because in my lifetime, I don't think this was a thing. But anyway, um, if you're looking for something where you're just getting that same payment all the time, uh, the stock market is not it, right? And crypto is not it. And really, even certain types of real estate aren't it, right? Like, I mean, you can see that the people that buy and sell the short-term rentals on Lofty every time it has a good or bad month, those are people that should not be investing in short-term rentals, right? Because the one thing that is certain is your income is going to be different every month. Um, I don't know. I think that's really all I want. I just want to talk about the general macro economy. I think even though it's something that I don't really dig into very often, just because there's so much going on, I thought it'd be sort of, negligent of me to not at least bring it up and talk about it a little bit. I also had some people just ask me to talk a little bit more about just general investing stuff and concepts and ideas, and so hopefully some of you found this helpful. I guess if you're still watching this, maybe you did. I really appreciate the people that have been watching to the end and commenting when they do. So thanks for that. I appreciate it. It's nice to hear, to see that there are some people that are hopefully getting some value out of some of these videos. Um, Feel free to reach out to me on the Discord or in the comments, and we can talk more about any of this stuff. It's certainly, especially, stocks and crypto are not stuff that I'm an expert in, although I have invested in each of those over time. And definitely even, I have an economics degree, but it's not, macroeconomic stuff. I think that that's where I really learned, like, you just can't, nobody's good at actually predicting it. If you were in any other field and you were wrong as often as economists are wrong, you'd be fired. So I don't know. Anyway, that's everything from me for today. Until next time, I'm just going to keep making mistakes so that you don't have to.